Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's nearly tax time, and if you're one of the millions of Australians who invest in shares, then it's important to think about what you need to report to the Australian Tax Office. And for many people, this might be unfamiliar terrain. Research by Finder suggests that more than 2 million people bought shares for the first time during the pandemic. Trading platform Stake, which is a supporter of this podcast, wants to help investors navigate tax time smoothly. So today we're going to look at a few things investors need to consider when preparing for the end of the financial year. Remember, this is general information only, and you should certainly seek professional advice when it comes to your own tax affairs. Elinor Kasapidis is the Senior Manager of Tax Policy at CPA Australia. Elinor, welcome back to Fear and Greed.
Thank you for having me back.
Let's start with the absolute basics. What are the potential tax liabilities for someone investing in shares on the ASX?
So if you're investing in shares on the ASX or any other exchange, you're going to incur capital gains when you sell or dispose of the asset. And at its simplest, the capital gain is the amount you receive when you sell the asset, minus the cost of buying the asset plus other costs you incur to hold and dispose of it. So they're things like maybe interest if you've taken out a loan, or financial advice fees when you're deciding on your investments. And that's known as the cost base. While you're holding the shares, you may also receive dividend income, or if you've bought unit trust items, then you'll get trust income. Those amounts are reportable as assessable income on your tax return as well. So while it sounds kind of complicated, at the end of the day, when you're receiving income from the shares, that gets reported on your tax return. And when you sell your shares, the capital gain on that also gets included in your tax return.
Okay, I actually think I followed you there, Elinor. I'm quite happy with that. So the thing there, so it's your dividend is income, your capital gain, but of course you take into account the cost of having those shares. That might be an interest payment, etc. So that's sort of the basic rules around it.
Exactly. Just like if you're buying a property and you have a mortgage and you might have conveyancing fees, it's the same sort of principles applied to shares.
Now, of course, the capital gain occurs when you sell the share. It's not when you're still holding the share.
That's right. Unrealized gains and losses. So it's not in shares, but in crypto assets, for example, we've seen some wild swings. The gain or loss from your investment doesn't actually occur until you've sold it, not while you're holding it.
Okay. So we're talking about capital gains, capital losses. Let's say someone bought, I don't really want to pick on those online retailers, but let's say we bought an online retailer in the middle of COVID and the share price is now half that and you've had to sell that. So what happens with the capital loss on shares?
Yep. So the market can move both ways. Sometimes you make a gain, sometimes you make a loss. The rules are that you apply any losses against your capital gain. So say you made a $100 loss on your shares because you had to sell them off, but maybe you sold a few others with a $200 gain. What you do is you offset those two against each other and you have a net capital gain of $100.
Okay. So can you explain, particularly to new investors listening, you mentioned dividends, and so that's a source of income, but the dividend imputation system, the idea of franked credits, what is that about?
Yeah, so when a company, especially listed companies, they pay generally tax at 30%. So when they pay out a dividend, they actually attach the 30 cents of tax that they've paid already to that dividend, and you can claim that back as a franking credit on your tax return. Essentially what it's doing is making sure that you don't pay another set of tax on top of what the company's already paid beforehand. So what you'll see going through is that you have franking credits labels on the tax return, and when you get your statements from the platforms that tell you how you've bought and sold the dividends that you've received, they'll show you the amount of the dividend and the amount of the franking credit.
Stay with me, Elinor. We'll be back in a minute. I'm speaking to Elinor Kasapidis, Senior Manager of Tax Policy at CPA Australia. Okay, so that whole double taxation, the idea that the company pays Australian tax, therefore why should I, as a shareholder who's getting this dividend in after-tax earnings from the company, why should I pay double tax on that? So I get that. What about when they start talking about partly franked dividends and those sorts of things?
Yeah. So not every dividend is going to be fully franked. And it's one of those things where if a company, for example, decides to retain some capital, or perhaps they've had some taxable losses, which means that even though they might be making a profit on the financial statements, when it comes to the tax, they might have large deductions. So they don't actually pay tax, and they therefore don't have any credits to attach to the dividend. And that's where you'll see either zero unfranked dividends, or you'll have partially franked dividends. And once again, your statements should show how much franking credit you can actually claim against that dividend income. And interestingly enough, it is a good idea with the avoidance of double taxation, but Australia is actually one of the last countries in the world to have an imputation regime. So it's something that's very true to our heart, but it's not necessarily how other tax systems around the world work.
And of course, there is some discussion at the moment about changing some of the rules around dividend imputation. The idea being that some forms of income for companies shouldn't get the franking credits.
It's always a tricky area to wade into. And because we've got it so set up and well established and investors understand the rules, sometimes making a big shift from that can be really difficult. And we need to have a good solution that doesn't impact too many people and investments negatively. So tax reform is always a difficult area.
Yes, indeed it is. In fact, the last time you were on the show, I think Adam Lang interviewed you. No one likes talking about tax reform more than him. So I'm sure that if he was interviewing you today, that's where we'd be going. But we're not. We're going to go overseas shares. So nowadays it's much easier to buy US stocks from a tax perspective. So let's say I bought Apple shares and I sold Apple shares at some point in the last 12 months. Do I think about it any differently?
No, if you're an Australian tax resident, you're actually taxed on both your Australian source income as well as your foreign source income. And whenever we head over the borders, world of international tax kicks in. So you'll not only have your Australian tax obligations, but depending on where you're investing, they're going to have rules for their foreign investment regimes. So I think it's really around know where you're headed, know who you're buying from, and understand the tax rules in the jurisdiction that they're operating from.
So just using that as an example, if I'm an Australian tax resident and I buy Apple shares, then I'm going to be taxed on any capital gain or loss I get from that. But there is the potential. I mean, do I need to see someone, an advisor, about whether I have to pay US tax, or is that normally done through my broker?
Well, it will depend on your broker's terms and conditions. You definitely might want to consider going through a broker who is familiar with the market, let's say the US. The dividend income as well that you might receive is accessible. So it's not just your capital gains and losses, but if it's dividend income, or often exchange traded funds are quite popular with investors, and they will actually have distributions from unit trusts. They'll have a whole mix of income coming through. So the more complicated, or I guess the more uncertain you are about the country that you're trading with or where those shares are located, the more you should consider getting professional advice and speaking to a registered tax agent who understands the rules.
Okay. Now, moving on. The ATO has revealed that what it will be targeting this year, and top of the list is landlords overclaiming tax deductions. Apparently, I couldn't believe this stat, 9 out of 10 landlords make mistakes in their tax returns, incorrectly claiming expenses. I don't know whether that says something about the landlords, whether that says something about the rules around it. But whatever it is there a general rule of thumb here for landlords when considering doing their tax, particularly around expenses?
It's definitely a bit of both. So there are some landlords who are not properly keeping records, which makes it really hard for them to substantiate. But also a lot of the rules around property investing or tax more generally can be a bit wishy-washy, or the expectations and the reality of what the ATO wants to see versus what actually happens can be quite stark. And CPA Australia, we came up with the 3 R's of tax literacy for this tax time, just to remind, listeners and taxpayers about some key rules. So the first one is to record everything. As we understand it, a lot of the claims are getting thrown out, not because it wasn't a deduction that might be available, but simply because the landlords aren't keeping the right records, or they're misclassifying things, not understanding the rules. So there's that complexity element as well. So if you record everything and have detailed information, whether you do it yourself or you go and see a registered tax agent, you'll be able to justify your claim. The tax agent can calculate the right amount of deductions. And when the ATO, or if the ATO comes and checks, you get that 1 in 10 tick of approval for having the right records. So it really is about recording everything. The other thing is about being reasonable. We have heard examples where, taxpayers will go or landlords will go to a tax agent and sort of assure them and confirm that, I spent all of this money on repairs and maintenance when in fact they did a big renovation, for example. So sometimes the claims that they're trying to make are not reasonable. So you really want to be thinking as a landlord and as a tax agent, what is the realistic margin that should be made? Are they overclaiming the interest expenses? Does it look a bit high? So again, people will try to claim all the interest when they've withdrawn or redrawn a whole amount of money that's for personal use, or they're trying to claim the private part of their home Airbnb stay or something like that. Thirdly, it's the reaching out. It's really about getting the right advice. Clearly, the law is complex. There are grey areas and the terms can get really confusing. Like, really, what's the difference between a repair and installing a new kitchen? It's all the same thing. But when it comes to the ATO, they don't see things the same way. So those are really the areas, I think, where landlords in particular, but just investors in general. So same with your shares. If you've got, loans to fund your investments, make sure you're keeping records of both sides of the ledger. If you need to provide evidence about your cost base, so the expenses that you've incurred, make sure you have those receipts and keep them for as long as you hold the asset, plus the necessary period after you've lodged the return.
Okay, and I presume that applies in its own way to other, like another focus for the ATO was work expenses, for example.
Yep, definitely. So anecdotally, our members are reporting that the ATO is definitely on the beat with work-related expenses, and they have real-time comparison and scanning of claims to pick out the ones that look unreasonable. So again, when people are trying to claim their Tim Tam expenditure or perhaps doggy daycare as work from home, the ATO is onto it pretty quickly. And again, a lot of the time with work from home diaries, the rules changed earlier this year. You need to be keeping daily records or logbooks for motor vehicle expenses. A lot of those claims are getting thrown out because they're missing the necessary information. The ATO is getting quite tough, and records are where a lot of people are falling down.
The other thing I must say about the ATO, anytime I've dealt with them when I've rung them because I haven't understood such stuff, they've been fantastic. They're actually very open to have a conversation with you.
Yeah, definitely. They do have that educate approach, and their website is a treasure trove of information. They've invested a lot in that. Often what we find is that it's a really good place to go when you've got simple affairs or perhaps a general question. When it comes to the level of detail, if you've got a complex portfolio or you're investing overseas, that's where a registered tax agent like a CPA can give you that additional tailored advice.
Elinor, thank you for talking to Fear and Greed.
Thanks so much for having me.
That was Elinor Kasapidis, Senior Manager of Tax Policy at CPA Australia. This is the Fear and Greed Daily Interview brought to you today by Stake. Remember, this was general information only and you should get professional tax advice tailored to you. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.